We are very pleased to welcome Professoressa Mariana Mazzucato to Scuola Superiore Sant'Anna of Pisa for Design at Initiatives. Mariana Mazzucato is professor at Sussex University and published her last book, The Entrepreneurial State. In your last book, you have introduced a somewhat unconventional view of the role of the state in the economy. Could you provide for us a further interpretation of the idea of what the entrepreneurial state is?
Sure. So the entrepreneurial state basically argues that the role that the state has played in the few places that have actually succeeded in generating smart innovation-led growth has gone way beyond the usual economics justification for the role of the state, which is to fix market failures. What the state actually did through its decentralized network of different types of state agencies was actually to create and shape markets actively through mission-oriented policies. So not fixing market failures with bandages, but actually envisioning the direction of change and really also directing those investments in not through tax incentives, but actually, you want internet to happen, you fund internet. You want to fund high-growth, innovative companies, you choose those companies and you fund them. Whereas some countries, when they think about innovation, they try to do this indirectly through tax incentives or through different types of funding schemes, which are pretty narrow, thinking just about the market failure problem. For example, funding basic research, which is a typical public good. What we see in Silicon Valley was funding across the entire innovation chain. Basic research, applied research, and early stage seed financing of companies. I call this the entrepreneurial state because it's extremely risky. It requires lots of ability to think about that uncertain landscape, and economists don't really have a way to talk about this.
Thank you. In your work, you have also highlighted the importance of public investment banks, I mean in Brazil, China, or Germany. Looking at Europe, to what extent can we consider the European Investment Bank as the engine of the European economic innovation? We can talk about a necessary rethinking of the European Investment Bank.
Well, first of all, one of the things that we've observed in some recent work that I'm doing with Caetano Penna on public banks in the world is that they are really playing a very active role directing investments towards the green economy in different countries. So using Bloomberg New Energy Finance, you can actually see that just 4 banks, the China Development Bank, the Brazilian Development Bank, the European Investment Bank, and KfW, Germany's public bank, are the 4 most active, if you want, investors in that green space, much more than the venture capitalists, private equity, stock market, or even corporate actors. The question then is this good, is this bad? And the first point to make is we don't really have a framework that justifies such massive investment. So the China Development Bank is providing loans to its green companies in the range of between $2, $4, even $5 billion worth of money just to individual green companies. And this isn't that different, actually, besides the scale of the funding, to this very direct kind of financing that occurred in the US, but not through public banks. So in some ways, you could argue that public banks in the green economy are playing the kind of role that some government agencies played in the IT revolution. They are, however, often accused of being anti-competitive because this looks a bit too active, a bit too directed, as opposed to just funding the general sort of conditions for innovation. And this poses a problem for us in terms of our ability to really evaluate these investments in an objective way, because we don't really have a framework through which to understand this very heavy, both scale and scope, directed financing from public banks. In Europe, the European Investment Bank, I think, could actually be more active. It was very active right after the crisis, and then it actually stopped some of its investments because it was fearful of its credit rating. Today, it is actually recapitalizing itself, but I think what we're missing is a way to think about the EIB strategy alongside the European Central Bank strategy. So we know, for example, that quantitative easing alone doesn't really work. It staves off, if you want, speculation from the financial markets, but it doesn't necessarily find its way into the real economy. Lots of the quantitative easing in the US, for example, just ended up in the banks and the bank coffers. So the EIB, I think, is important in terms of sort of co-financing the ECB creation of money, so that we have a way to direct the ECB money creation into the real economy, so we don't get what we saw in the US, which was money creation ending up just remaining within the financial sector or in the corporate sector, which then doesn't spend, right? They're massive hoarding rates. So I think the kind of directionality that could be directing, or the kind of directionality that could be used to think about EIB investments could actually be useful in terms of making sure that these lender of last resort kind of policies don't just worry about showing that you have a lender of last resort, so staving off the financial market speculation, but actually nurturing real growth in the real economy.
Okay. Today you finished your presentation saying that government has to share both risk but also rewards. You think that today states receive inadequate revenue for their investment, and if yes, which policies are necessary in order to guarantee adequate revenue for the role of the state in innovation?
Okay, so because I talk about the entrepreneurial state as taking on massive risk, the first point is that in order to make sure you don't put all your eggs in one basket, you need a portfolio approach. You need to be financing sort of different types of technology sectors, firms, and many of these investments will indeed fail. Just look at recently, the Obama administration gave a $465 million guaranteed loan to Tesla, $500 million guaranteed loan to Solyndra. Solyndra failed. Tesla is very successful. The statistics out there more or less show us that for every success, you have kind of 10 failures. So the real question for government is, when it is doing these kind of directed investments, how can it make sure that some of the upside from the successes can also cover the downside losses? In economics, we assume this will just happen through taxation. The problem is both the large companies that have benefited immensely from government investments often don't pay much tax, but even if they did, because of course we could close the loopholes if we wanted to, what's happened to tax is interesting. So for example, capital gains tax fell by 50% precisely through the lobbying of the National Venture Capital Association in the US. And so there's been this co-evolution of a narrative about who the innovators are and changes to taxes. So that's also a problem, because that narrative was wrong. The venture capitalists, for example, have always come in decades after the government has spent this very high-risk money on different areas. So I basically argue that in order to be a little bit less naive, so we don't just socialize the risks but also the rewards, we need to do different things. One might be also to reform the tax system, both so it works, as well as consider maybe increasing capital gains tax, which there's no reason it should be as low as it is, but also maybe retaining a golden share of the patents for those areas, maybe those few areas where it's just so clear and obvious that, for example, the drugs and the pharmaceutical industry trace their research back to public research, so that you don't have the taxpayers paying twice for the research and then for these very high prices of drugs. Having said that, we could also focus on the prices. So the prices of those drugs, for example, whose research was publicly funded, should also be capped. That would be another way to reap back the rewards. Another way might be, in some cases, when it's actually financing companies themselves, to retain some equity. So some of the upside from the Tesla success could have gone to fund the Solyndra loss if some equity had been retained. Anyway, the point is not so much for me, Mariana Mazzucato, to say exactly which tool to use. We actually need lots of lawyers to help us form these contracts. But in a world of big data, it's interesting that we consider anything like this maybe too complicated. Those same advocates of big data sometimes say to me, oh no, it'll be too difficult to form these contracts, which is like, okay, so when you see things fueling corporate profits, it's easy. As soon as we start asking for some of the upside to come back to government, it's just too difficult. I think there's lots of ideology that's preventing us from actually really thinking creatively about these tools. Okay,
thank you. Looking more deeply at innovation. Today we are experiencing the boom of startup. Today it seems that the innovation paradigm is represented by the startups. In Europe, the economic attention to startups is growing faster and faster. But to what extent the governments have to encourage the startup projects for creating innovation?
I think startups are very much part of the myth about innovation. So of course, yes, startups are important, but the problem is that most startups fail. And in fact, if we look at small companies in general, so not just the age, but the size, and there's lots of SME policy in Europe, most SMEs are not productive, they're not innovative, and they're not net job creators. Only about 5 to 6% of them are. So really what governments should be thinking about is not just to have this folkloric attachment to startups or SMEs, but really to create the kind of sort of broad-based innovation system from, again, basic research, applied research, early stage financing of companies, as well as all the horizontal linkages, science-industry links, patient long-term capital, for example, through the public banks as well. And in that kind of environment, we know that startups, those few ones that actually have some sort of potential to grow, that are really making a commitment to spending on innovation in different ways, have a greater chance, if you want, of surviving. But that's very different from just having startup or spin out or SME policy. And one of the things that startups need is a proper, if you want, symbiotic relationship with the large companies. And unfortunately, as these large companies are getting increasingly financialized, they might then just buy out some of these small companies, but don't necessarily nurture the innovation process once they are in that large company. So that's another emphasis I think that policymakers might do well to think about, which is how to nurture more healthy relationships between large and small companies, and part of that requires large companies to become less financialized and reinvest more of their profits back into areas like human capital and R&D, so when they do buy up these smaller companies, they are within a nest that's a bit healthier than the current financialized one.
Okay, staying on the subject, we know that the Italian enterprises scenario is mainly made up by small firms. What kind of policies do you think Italian government need in order to improve and encourage innovation?
Well, first of all, I think Italian policy shouldn't necessarily see the status quo as its strength. So this fact that there's lots of small companies in Italy doesn't mean that we should have small company policy. We should really be trying to get those small companies to become medium-sized companies, at least, if not large companies, more similar to, say, the German model. Now, if we look at the German model, what those companies have required, again, is this kind of patient, long-term committed finance provided from the KfW, these Fraunhofer institutes, which are providing the kind of knowledge base that these companies absolutely require to commercialize their R&D and to benefit from the science that's coming from the universities. And so, again, I think that growth process is what we should be thinking about, not just SME policy, protecting SMEs or financing SMEs. It's about thinking of the kind of conditions that SMEs, small companies, require in order to grow. And that's very different from the kind of policies we see today, which assume, for example, that we have a financing gap for SMEs. The evidence shows that actually most of the innovative small companies do find the finance they need. So we should really be focusing on the kind of conditions that those few innovative small companies require. And the rest of them, one could even argue, let them die. I know that sounds really harsh, but actually we know, for example, teachers are very important to an innovation system, but I don't hear anyone saying we should just give them money. So we shouldn't make some folkloric story around SMEs, but really think about what conditions are needed for innovation and innovation-led growth and support that process, as opposed to the teddy bear SME story.
Thank you very much for being here.
You're welcome.